7.6 trillion, that's the number stamped in the corner of a quarterly balance sheet, printed on paper so thin it curls under its own weight, locked inside a vault that smells like toner and old fear. Close-up of a trembling financial statement under fluorescent light. While the news focused on AI rallies and election theater, the real money was doing something quieter, rotating, draining, repositioning. The chart didn't explode, it sagged. A slow-motion cave-in of sovereign bonds, the kind that doesn't make headlines because it doesn't scream, it suffocates. Graph of bond prices sliding downward, volume bars rising like teeth. And somewhere between the pension funds and the central banks, I bought gold and silver at all-time highs. Not because I'm brave, because the math stopped working. Every cycle has a moment when prices lie, when assets look expensive because the measuring stick is broken, when the dollar value is screaming top, but the real value is whispering run. Macro shot of a gold bar weighed on a scale, the needle shaking. This wasn't a trade, it was a translation from paper promises into weight, from digits into density. If you rent, this decides whether you ever own. If you own, this decides whether you keep it. If you save in cash, this decides how quietly it disappears. This is how the trap works. Start with the bond market, the plumbing beneath the skyscraper. Bonds are supposed to be boring, predictable, a promise that time equals safety. But the promise only holds if yields behave. When yields spike, prices collapse. And when prices collapse, collateral evaporates. Animated schematic of bonds cracking like ice. Yield curve control was designed to prevent that, to pin long-term rates so governments could borrow without panic. Think of it like a dam holding back pressure. It works until the water rises faster than concrete can cure. Dam wall fracturing, water seeping through. Then there's the repo market. Overnight loans, collateralized by treasuries, moving trillions before breakfast. It's the heartbeat of modern finance. When collateral loses value, the heart stutters. Banks demand more margin. Margin calls for selling. Selling pushes yields higher. Higher yields crush prices again. A reflex loop. EKG line flattening into chaos. Basel III tightened the rules, forcing banks to hold high-quality liquid assets. On paper, that's treasuries. In practice, it's a crowded exit. When everyone holds the same safety, safety becomes volatility. It's musical chairs with spreadsheets, empty chairs circling a conference table. Here's the metaphor. Imagine the global financial system as a warehouse stacked to the ceiling with boxes labeled risk-free. A small fire breaks out. Sprinklers turn on. The labels dissolve. Now nobody knows which boxes are flammable, so they all run. Warehouse lights flicker as workers flee. That's why prices are up, not because demand is wild, but because trust is thin. Inflation isn't just more money chasing fewer goods. It's fewer truths, backing more promises. So I bought metals at the top, because the top was measured in a currency being diluted by design. Close-up of a printing press churning bills. To understand where this ends, we have to look at 1971. August, Nixon on television. A calm voice announcing the temporary suspension of gold convertibility. The window closed, the anchor cut, the dollar floated, and never stopped drifting. Black and white TV footage warping. Before 1971, dollars were receipts. After, they were stories. And stories need constant reinforcement. Debt became policy. Inflation became lubricant. Savers became donors. Timeline snapping from gold back to fiat. Then look at 1929. Not the crash, the run-up. Margin debt exploding. Newspapers celebrating a new era. Sound familiar? The collapse wasn't caused by fear. It was caused by leverage meeting reality. 1920s ticker tape falling like snow. Or Rome, debased coinage. Silver content shaved to fund wars and bread. Prices rose, trust fell. Empires don't fall when they're attacked. They fall when money stops meaning what it says. Ancient coin dissolving into dust. History doesn't announce itself. It echoes. So here's the forward scenario. If yields stay high, governments roll debt at higher cost. If governments roll debt at higher cost, deficits expand. If deficits expand, central banks intervene. Not with speeches, but with balance sheets. Liquidity returns. Currency weakens. Real assets reprice. Dominoes labeled if, then toppling. If they cap yields again, they admit the market is broken. That's bullish for metals. If they don't, something else breaks. Pensions, banks, housing affordability, also bullish for metals. The fork in the road leads to the same mountain, forked road merging into a peak. Over the next 12 to 24 months, the unprepared chase returns in instruments priced off manipulated rates. They hold duration risk they don't understand. They believe the CPI print. They discover too late that real yield was a marketing term. Crowd staring at glowing screens, faces anxious. The prepared do something boring. They reduce counterparty risk. They hold assets without earnings calls. They plan exits before entries. They know liquidity events are violent and brief. Quiet room, safe opening slowly. My exit is 2026. Not because I know the date, because I know the condition. When central banks pivot hard enough that headlines declare victory. When real rates go decisively negative. When retail finally arrives, bragging about metals the way they bragged about tech stocks. When dealers run out of inventory and offer paper substitutes. That's the top in narrative terms. News headlines flashing inflation beat. I don't sell into panic. I sell into consensus. Gold and silver aren't investments. They're time machines. They move value from one era to the next. The trick is stepping out before the next illusion forms. Metal bars morphing into blueprints. This isn't about getting rich. It's about not getting erased. Because cycles don't care about your politics, or your optimism, or your spreadsheets. They care about math, and math has a memory. All-time high is a comforting phrase. It suggests a summit, a limit, a place where gravity finally wins. But that comfort only exists if the unit of measurement is stable. And today, the unit is not just unstable, it's actively decomposing. When gold or silver prints an all-time high, the reflex response is disbelief. Too expensive. Missed it. Late. That reaction assumes the price is telling you something about the asset. In reality, it's telling you something about the denominator. The dollar, the euro, the yen, the measuring stick itself. Prices don't exist in a vacuum. They are ratios. One thing measured against another. When the another is being diluted, leveraged, and politically engineered, the ratio loses meaning. An all-time high in a failing unit is not a ceiling. It's a symptom. This is the first mental shift most people never make. Price is not value. When currency is policy. In a sound system, money is a neutral yardstick. It measures effort, scarcity, and time. In an unsound system, money becomes an instrument of policy. Its purpose is no longer to measure reality, but to modify behavior. Lower rates to encourage borrowing. Inflate asset prices to create a wealth effect. Suppress volatility to preserve confidence. Each intervention bends the ruler slightly. Over decades, the ruler becomes rubber. When central banks expand balance sheets faster than productive capacity grows, currency units multiply without a corresponding increase in real goods. The result is not always visible as consumer inflation at first. It shows up in asset prices, stocks, real estate, art, and eventually metals. Calling those moves bubbles misses the point. A bubble implies excess enthusiasm, and what we're seeing is excess currency. Assets aren't necessarily going up. Money is going down. In that environment, expensive loses coherence. The bond market broke the thermometer. For decades, bonds were the anchor. Yield reflected risk, time preference, and inflation expectations. That anchor is gone. Yield curve control, quantitative easing, and regulatory demand for sovereign debt have turned the bond market from a price discovery mechanism into a policy tool. When yields are capped by mandate and buyers are forced by regulation, the signal is corrupted. It's like measuring body temperature with a thermometer that adjusts itself to avoid alarming you. The reading looks calm. The fever spreads anyway. Once bonds stop telling the truth, everything priced off them inherits the lie. Discount rates, valuations, pensions, insurance models, all downstream assumptions rot quietly. Gold and silver respond not to inflation prints, but to this deeper signal, the loss of honest price discovery. They rise not because they are productive, but because they are outside the system that is lying. High. Compared to what? An all-time high only makes sense relative to a stable past, but the past decade was not stable. It was engineered. Zero interest rates were not normal. Negative real yields were not accidental. They were emergency measures that never ended. A generation of prices was formed under artificial gravity. Comparing today's metal prices to those years is like comparing sea level before and after the ice caps melt. The reference point is gone. If your measuring unit has lost 30, 40, 50% of its purchasing power over a cycle, then a nominal high may still represent a real low, especially for assets with no counterparty risk and limited supply growth. The question isn't, is gold expensive? The question is, what does expensive even mean when money is being sacrificed for stability? All-time highs are psychological weapons. Markets weaponize language. All-time high is meant to trigger hesitation. It frames the buyer as reckless and the non-buyer as prudent. But historically, the biggest real gains in hard assets happen after repeated all-time highs. Not because momentum traders pile in, but because the currency regime continues to decay. In the 1970s, gold made multiple all-time highs on its way from $35 to over $800. Each high looked absurd, until the next one printed. The metal didn't change, the dollar did. The same pattern repeats across centuries. Roman denarii, Weimar marks, British pounds, post-empire. The asset isn't climbing a mountain. The ground beneath the currency is sinking. When the ruler breaks, weight matters. In a fully financialized world, most assets are claims on claims. Someone else's liability, someone else's promise. They work beautifully until confidence fractures. Gold and silver are primitive by design. They don't scale well. They don't yield. They don't care about narratives. That's their strength. When the measuring unit breaks, you don't want clever instruments. You want mass, density, something that doesn't require belief to function. Buying metals at all-time highs is not a bet on price appreciation. It's a refusal to play a game where the rules change mid-measurement. The real risk is waiting for cheap. Waiting for a pullback assumes the system will offer one in real terms, that liquidity will remain abundant, that confidence will hold, that exit doors will stay open. History suggests otherwise. When currency regimes shift, repricing is fast and discontinuous. Gaps replace trends. Availability matters more than charts. By the time something feels cheap, it's usually inaccessible. Cyclical crises are familiar. They rise, they fall, and they reset. A boom overheats. A bust cleanses excess. Then the system restarts, leaner and stronger. That story is comforting because it implies continuity. It implies that patience is rewarded and that time alone heals damage. This crisis doesn't fit that pattern. What we are living through is not a bad phase of a healthy system. It is the long exposure of a system whose foundations were quietly altered decades ago. Cycles oscillate around a stable core. Structural failures occur when the core itself can no longer bear weight. And once that happens, there's no return to normal. There's only adaptation. Cycles correct behavior. Structures define limits. A cyclical crisis punishes excess behavior. Too much speculation, too much leverage, too much optimism. The cure is restraint, higher rates, bankruptcies, time. A structural crisis punishes design. It doesn't matter how disciplined participants are if the architecture itself forces instability. The global financial system today is designed around permanent debt expansion. Governments roll obligations they can never repay in real terms. Central banks are tasked not with preserving currency value, but with preventing deflation at all costs. Financial institutions are regulated into holding the same safe assets, ensuring crowding and fragility. This isn't a miscalculation, it's a blueprint. You cannot cycle your way out of a design constraint. The bond market is the fault line. Every modern economy is built on debt. Debt is priced in the bond market. That makes bonds the structural load-bearing beam of the entire system. In a cyclical downturn, yields rise or fall to reflect risk and opportunity. Capital reallocates. Loss is clear. In a structural crisis, yields are politically intolerable. Governments cannot afford market clearing rates, so intervention becomes permanent. Yield curve control, quantitative easing, emergency facilities that never close. Each measure is introduced as temporary. Each becomes structural. Once yields are capped by policy, bonds stop functioning as a signal. They become a tool. And when the tool breaks, everything built on it destabilizes. Pensions assume certain returns. Banks assume certain durations. Governments assume certain rollover costs. None of those assumptions hold if yields are real. So yields must be managed, which means markets must be suppressed, which means risk accumulates invisibly. That is not a cycle. That is a trap. Liquidity is now a life support system. In previous eras, liquidity was a stimulus. Today, it is oxygen. The system cannot tolerate withdrawal. Balance sheets are too large. Leverage is too embedded. Even small rate increases cascade through derivatives, collateral chains, and funding markets. This is why every tightening cycle ends in panic, not because policymakers are incompetent, but because the structure is dependent. Repo market seizures. Bank funding stress. Shadow banking cracks. Each episode is treated as a shock. In reality, they are symptoms of the same condition, a system that requires constant flow to remain upright. Structural dependence replaces cyclical resilience. Regulation has increased fragility, not stability. Basel III was designed to make banks safer, higher capital requirements, more high-quality liquid assets. On paper, it worked. In practice, it concentrated risk. When every institution is incentivized, or forced, to hold the same sovereign bonds, diversity disappears. What looks safe individually becomes dangerous collectively. This is the paradox of modern regulation. By reducing micro-level risk, it amplifies macro-level failure. The system becomes efficient but brittle. Cyclical systems bend, structural failures snap. Inflation is a feature, not a bug. In a cyclical crisis, inflation is an imbalance. It can be corrected. In a structural crisis, inflation is a release valve. Debt that cannot be defaulted must be diluted. Social contracts that cannot be renegotiated must be quietly altered. Inflation performs both functions without votes or headlines. This is why inflation is tolerated, redefined, and managed rhetorically rather than eliminated. It is the least politically explosive solution to a mathematically unsolvable problem. Expecting policymakers to beat inflation is like expecting a pressure cooker to choose not to vent. Why this changes personal strategy. If this were cyclical, the strategy would be simple. Wait, hold cash, buy the dip. Trust reversion, structural crises punish that logic. Cash becomes a wasting asset. Risk-free returns disappear. Traditional diversification fails because correlations converge. The system stops offering obvious safe harbors. Survival shifts from timing to positioning. Assets are no longer evaluated by upside potential alone, but by durability under systemic stress. Counterparty risk matters more than yield. Liquidity matters more than theoretical return. This is why hard assets reassert relevance, not as trades, but as structural hedges. The danger of misdiagnosis: calling a structural crisis cyclical leads to catastrophic errors. People overexposed to paper assets assuming recovery. Institutions extend duration, assuming normalization. Policymakers delay reform, assuming growth will save them. It won't. Structural crises end in resets, not rebounds. Currency reforms, financial repression, capital controls, debt jubilees, explicit or disguised. The question is not whether change comes. It's whether you recognize the type of crisis you're in before it forces recognition upon you. Because cycles teach lessons. Structures enforce them. Most investors obsess over price, targets, levels, Fibonacci lines and round numbers that feel scientific but behave like superstition. They believe exits are mechanical, that a number on a screen will tell them when a trade is done. In structural crises, price is the last signal to change. Narrative is the first. Markets don't turn when valuations peak. They turn when stories saturate, when an idea completes its journey from fringe to fashionable to unquestioned. That is when risk quietly inverts. The real exits happen when the room nods in unison. Price moves first, narrative moves last. Early in any major repricing, price leads narrative. Assets move while the media dismisses it as noise. Analysts explain it away. The public ignores it. Then something shifts. The explanations stop sounding defensive and start sounding proud. Headlines change tone. Participation widens. By the time the narrative catches up, price has already done the heavy lifting. This lag is why price-based exits fail. Waiting for a top means waiting for consensus. And consensus is the exit liquidity of last resort. Narratives create buyers. Not value narratives don't make assets valuable. They make them socially acceptable to own. In the early stages, owning an asset feels uncomfortable. You look wrong. You sound paranoid. You're asked to justify yourself. That discomfort is information. It tells you the narrative is immature. As the narrative strengthens, discomfort fades. Ownership becomes casual, then celebrated, then recommended. That's when the risk peaks. Gold, silver, and hard assets are no exception. When they're mocked, they're early. When they're tolerated, they're advancing. When they're praised by the same voices that once dismissed them, they're nearing exhaustion. Central banks as narrative architects. The most powerful storytellers in markets are not influencers or journalists. They are central banks. When central banks speak, narratives realign. Transitory, soft landing, mission accomplished. These phrases don't describe reality, they manage perception. The exit signal isn't a price spike, it's a rhetorical pivot. When inflation is rebranded as controlled, when financial repression is framed as stability, when negative real rates are celebrated as growth-friendly, that's the moment. Not because the system is healed, but because belief has been restored. Markets don't collapse when fear is high. They collapse when trust is misplaced. The retail arrival is the bell. Every major asset cycle ends the same way, with accessibility, when barriers fall, when products proliferate, when ownership is simplified and packaged, when ads appear explaining why everyone should own this. That's not democratization, it's distribution. In metals, that looks like shortages in physical supply paired with an explosion of paper substitutes. ETFs, digital gold, fractional exposure. Convenience replaces custody. Price may still rise during this phase, but risk rises faster. When an asset no longer requires conviction to own, it's no longer compensating you for risk. Selling into calm, not chaos. The instinct to sell into panic is emotional. It feels logical. Get out before it gets worse. But panic often arrives late. By the time it's visible, repricing has already occurred. The disciplined exit is quieter. It happens when volatility is low and confidence is high. When your thesis is no longer controversial. When strangers repeat your reasoning without understanding it. That's when you reduce exposure. Because what you're really exiting is not the asset, but the crowd. Time-based exits are anchors, not predictions. Setting a date, like 2026, isn't prophecy. It's a forcing function. It prevents narrative intoxication. It reminds you that every hedge has a season, that even protection can become risk if held too long. The date matters less than the conditions. Deeply negative real rates, aggressive monetary easing framed as victory, political pressure to stimulate at all costs, media consensus that the crisis has passed. Those are narrative markers. When they align, price becomes irrelevant. Why this is hard to execute. Narrative exits require emotional detachment. You will feel foolish selling something that is still rising. You will doubt yourself when everyone else feels validated. You will be told you're leaving money on the table. You are. That's the cost of survival. Maximum profit and maximum safety never overlap. The exit is always early by design. Those who wait for price confirmation end up selling to someone who read the narrative sooner. The final inversion. At the start of a crisis, protection feels risky. At the end, risk feels protective. That inversion is the tell. When the asset you bought for safety is now bought for return, it has changed roles, and so must you. The exit is not a reaction to charts. It's a response to belief. And belief, once unanimous, is always late.